You ready? For this mock exercise, we're going to take a look at a company called Thomson Limited, and we're going to analyze the impact of inventory errors for a 3-year period. So let's take a look at the question. So these are the books and records of Thomson Limited, and we were given 2011 to 2013. And what we're provided is information on income statement and balance sheet information. And these are the following 2 errors. So the first error, and they discovered this in December 2013. So the first error is the ending inventory in 2011 was understated by 10,000. And the second error is the cost of goods purchased in 2012 included 25,000 in inventory that should have been recorded as a 2013 purchases. So they obviously recorded a purchase in the wrong year. They recorded it in 2012, but they should have recorded it in 2013. 2013 and 12 ending inventories were correctly counted and calculated. So essentially, they were able to figure out the ending balances, but the purchases was recorded in the wrong period. The first requirement asks us to determine the impact of net income and retained earnings for the past 3 years, and that is before and after the error correction, assuming the tax effect remains unchanged at 25%. And part 2 asks us to calculate the before and after inventory turnover. So there's a couple of learning concepts here that we're going to do. So first of all, let me actually do the before income statement, okay, and the before inventory turnover. Maybe that's the best way to start the question. So the net income for 2013, 2012, and 2011. So we've got net sales, okay, less cost of goods sold. So I'm going to do it in thousands. Less cost of goods sold. This is going to be the gross profit, GP for gross profit. So 42, 39, and 42. Operating expenses is 50, 52, and 50. This one has a loss of 8, loss of 13, and this one has a loss of 8. Now, the income tax, in this case, we're going to assume the income tax recovery at 25%. So 25% of 8 is 2. And this is 3.25. And this is 2. So the net loss is going to be 6, because we're going to assume that this loss can be offset against past prior income or future income, and that's a recovery, a tax recovery. And this is 9,725, 750, and this is minus 6. So that's the net income before. Now, what's the impact So we're asked to determine the impact on net income and retained earnings. So what I like to do is I like to so what don't I calculate? So maybe what I should do is calculate the inventory turnover before. So this is before correction, right? Before changes. So the turnover, what's the calculation of turnover? So inventory turnover is cost of goods sold divided by average inventory. So the only turnover I can do is 2013 and 2012 because I don't have the 2010 ending inventory. So for 2012, the cost of goods sold is 273 divided by the average inventory, which is 17, 29, and 17 divided by 2. So for 2012, the turnover is 11.9 times. And for 2013, the cost of goods sold is 258 divided by the average inventory, which is 17 and 29 divided by 2. Gives me 11. So this is 11.9 times, and this one is 11. This is 11.2 times, sorry. Okay, so that's the before. So this is the inventory turnover and net income before. Now let's deal with the errors. So the first error is ending inventory is understated. So what I like to do is when I analyze errors, I like to use this visual representation of the various components of calculating cost of goods sold and ending inventory. So this diagram reflects the relationship. So beginning inventory plus purchases gives you goods available for sale, stands for GAS. And we know that goods available for sale, some will be in ending inventory and the rest will go to cost of goods sold. So when I look at the first error, if 2011 ending inventory was understated, so if this is 2011 ending inventory is understated, right? So if 2011 ending inventory is understated by 10th K, that means that cost of goods sold has to be overstated by 10K in 2011. Okay, now if cost of goods sold is overstated, then that means that net income is understated by 10. Does that make sense? Now, what's the impact? The ending inventory is understated. For 2012, that ending inventory becomes beginning inventory. So for the following year, this ending inventory is going to be the beginning inventory for 2012. So beginning inventory is understated by 10K. Purchases is okay, which means that goods available for sale is understated by 10K. If goods available is understated by 10K, but ending inventory is okay, that means that cost of goods sold is understated by 10K, which means that net income in 2012 is overstated by 10K. Now, if I look at the year-to-date retained earnings, because the 2011 net income is understated by 10K, but 2012 net income is overstated by 10K, the net effect is no effect in year-to-date retained earnings for 2012. So what I wanted to go through the long way of explaining the effect on errors. Now, obviously, you'll see that for 2013, there is no effect because the error usually fixes itself in 2 years at the end of the second year. So let's go back to the first error again. So it says ending inventory was understated by 10. If the ending inventory for 2011 was understated by 10, that means that the cost of goods sold in 2011 was overstated. It has to be because goods available for sale is okay. So if this is understated, this is going to be overstated. If cost of goods sold is overstated, net income is understated. Now, what happens in 2012 is that the ending inventory in 11 becomes the beginning inventory in 2012. Because 2012 beginning inventory is understated, goods available for sale is understated by 10. Now, we're going to assume that the ending inventory is okay because those goods have been sold. If ending inventory is okay, then cost of goods sold by virtue of the goods available for sale being understated is also understated. If that's the case, net income is overstated. You'll see that the 2012 year-to-date retained earnings has no effect because of the offsetting effect in 2011-2012 net income. So that's the first error, right? The second error is this one. And it says, cost of goods purchased in 2012, $25,000 should have been recorded in 2013 purchases. So let's do this. So beginning inventory purchases gives you goods available for sale. So they're saying that in 2012, the purchases was recorded, but it should have been recorded in 2013. So this is overstated. So purchases in 2012 is overstated by $25K. That means that goods available for sale is overstated by $25K. Now we're told that the ending inventory was okay. So this is okay. That means that this has got to be an overstatement of $25K. So, right? Now for 2013, you'll see that the beginning inventory, and let's redo the map again. So now they're saying that they should have recorded that purchase in 2013. So the purchases, because it was recorded in 2012, the purchases is understated by $25K, which means that the goods available for sale is understated by $25K. And that means that cost of goods sold is understated by $25K. Now notice that the impact of this is that net income is understated by $25K. And this one is net income is overstated by $25K. But again, the effect for these 2 years is retained earnings has no effect. Now, we're going to go back to the question and we're going to say, okay, let's look at what the impact is to net income, all right? So why don't we do this? So why don't we take a look at the net income before. So this is before, so 2013, 2012, and 2011. What is the net income or net? So it would be a net loss, right? Before. We're going to exclude the tax for a minute. Net loss before is 8,000. This is 13,000. This is 8,000. So looking at the first error, right? This is the first error. You'll see that net income in 2011 is understated by 10. So 2011 is the first entry, the first adjustment is understated, which means we want to add 10,000 here. And 2012, the net income is overstated, so we want to subtract 10,000. Right? And for B, the second error, you'll see that net income is understated by 25 in 2012. If it's understated, we want to add 25,000. And for 2013, it's overstated by 25, so we want to subtract 25. So let's recalculate the revised net income. So the first one is we're going to have a $2,000 income. Okay? And this one is 23 less 25 is $2,000 income. And this one is 25 minus an 8 is 33,000 loss. We're going to calculate the tax at 25%. This is 8,250, 500. So that's the revised net income. In this case, net loss too as well, right? So we've got the before. I wanted to show you the before and after. So now we're going to calculate the revised inventory turnover. So how do we calculate the revised inventory turnover? So for 2012, our cost of goods sold was $273. Okay? $273. We had these two errors, right? And these two errors has an impact of $15,000. And that 15,000, if you remember back, what we did was cost of goods sold is overstated by 10, and in this case, it's cost of goods sold for 2012. It's understated by 10 and overstated by 25. So the net is an overstatement by 15, so that's why we're subtracting it from 273 to give us 258. And we're going to divide this by the average inventory. And that one did not change. Because remember, the ending inventory in both cases in 2012 was okay. So let's take a look at this for a minute. So 2012, the ending inventory, but look, the ending inventory, so why don't we do this? Why don't we put the inventory for 2011 of 17, right? And so 2011 ending inventory is understated, so we need to add a 10 to that one, right? This is for 2011. Plus the 2012 inventory, there was no effect on that one. There was no change. So the average of these inventory divided by 2 gives me 9.2 times. So we went from 11.9 times to 9.2 times. For 2013, you'll see that the cost of goods sold for 2013 was $258. Now, there was one effect, which is $25,000. And we know that netting, so what happened to $25,000 in 2013? Cost of goods sold was understated, so we need to add 25 to that cost of goods sold to give us 283. Divided by, now the ending inventory is 2013. That did not change. And that one is 17,000 plus 2012. That did not change either. Divided by 2 to give us 12.3 times. Okay, so the key takeaway is when we're trying to figure out the impact of the error, you got to remember that the error corrects itself at the end of the second year. So in the first error, we discovered that 2011 ending inventory was understated. If that's understated, the cost of goods sold has to be overstated because goods available for sale is perfect. So the error wasn't really on the beginning and purchases, so cost of goods available for sale is right. But if this is understated, this is going to be overstated. If that's overstated, net income is understated. In 2012, because ending inventory becomes the beginning inventory in the following year, then this is understated. Goods available for sale is understated. If this is okay, because that's already been, that inventory was probably sold, so ending inventory has no effect, then that means that cost of goods sold has to be understated, the net income is overstated. You'll see that the year-to-date retained earnings, okay, has no effect because the error in net income offset at the end of the second year. It washes out, the error washes out. In part B, when goods were purchased and they were recorded in the wrong period, again, in 2012, the purchases is overstated. They should have recorded in 2013, but they end up recording it in 2012. So purchases is overstated. Goods available for sale is overstated. Now, we're going to assume that ending inventory is okay because they told us in the question that the ending inventories for both 2012 and 13 were counted properly. That means that the error has to affect the cost of goods sold. So cost of goods sold is overstated, which means net income is understated. Now, purchases in the following year, you can see that it's understated because they should have recorded in 2013. They didn't. So that's understated. Goods available for sale is understated. And again, cost of goods sold is understated, net income is overstated. But the net effect of retained earnings has no effect at the end of the second year, 2013. So what I try to do here is I try to show you that this is the net income before, or net loss before the adjustment. And what I try to do is look at the changes to net income, or in this case, the cost of goods sold effect on the error for both A and B, our analysis. And you can see that the revised net income will show a different set of income. Okay? And of course, that will translate to a different turnover. Thank you.